I mean, I find it hard not to have interpreted Powell's press conference from last month as basically saying, I'm declaring war on jobs. He put up the chart several times of the 2 job openings for every applicant, said, I just think this is, it's too strong right now. I got to bring that down. We're already beginning to see some cooling off in the job market. There's some charts I think you put up there showing the difference between the absolute number of jobs versus the year percent changes in job openings. Initial claims are starting to rise. Granted, they got down pretty low, but it looks like we're seeing a secular reversal there. And then I've got a chart I'll put up here of tech startup layoffs. I've been sort of showing this chart on Twitter as May has been progressing. You can see starting about 2 months ago, layoffs are really shooting back up, kind of the levels where we were at in kind of mid 2020, right? So it's not apocalypse yet in the jobs market, but we're certainly seeing some real signs that employers are starting to pull back. And of course, they have a progression, right? They go from hiring freezes to then shortening hours and then to layoffs. But like I said, we're already beginning to see layoffs, begin to creep into the picture here. So how worried are you about what's the job market from here?
I think that's one of the key things to focus on. I think we're going to see more weakness in the job market. Basically, the Federal Reserve has 2 mandates and a shadow mandate, right? So they want to have stable prices. They want to have low unemployment. And they want to, the shadow mandate is financial stability, right? So if something goes illiquid, especially if it's like a treasury market or credit market or something like that, they have to address that. And so with official inflation as high as it is, and with official unemployment as low as it is, and with nothing, really seized up in the financial markets yet, their clear mandate is to try to tighten and to decrease inflation, increase unemployment a little bit. And so that's the path that they're on. It's like an algorithm, and they're following that algorithm. And I think the challenge is that the walls are closing. They're getting narrower and narrower. So that they basically balance between trying to support those 2 mandates, and it gets closer and closer, where you eventually just get stuck, where you're kind of already you're fully focusing on one, but you still can't fix it, and the other one's closing in on you as well. And so I think that going forward, until we see their shadow mandate come into play, until something in financial markets truly breaks, like treasury market liquidity or credit market liquidity, something like that, I think their clear focus is going to be on softening the job market. And so I would keep looking at that as a key thing to watch going forward. And I think that we're over the next 6 months, 12 months, we're going to see that shift towards a weaker job market. And it might or might not bring inflation down. Depends on what happens with oil production, what happens with China reopening, right? There's a lot of variables that can affect specifically what happens with inflation. But I think longer term, the inflationary forces are going to remain, and that they're going to have to end up backing off their decision to create more unemployment.
Okay, and so I'm gonna bang through a couple other topics here real quickly that I'd love to spend more time on individually, but we're just time constrained here. But where I'm going with this list is to the question of by decreasing demand so much and creating a negative wealth effect, which is really what the Fed's trying to do to bring demand down. How big is the risk of tipping into a recession here? Because part of what I'm trying to do for the folks that watch these videos is to kind of let them know where the puck is heading, so that if we think, hey, we could be entering a recession where stock prices might continue going down further, your house price might come down, your job might be at risk. I want people to know the relative probability of that so that they can take prudent action now in their lives if they feel unduly vulnerable to any or all of those factors, right? So real quick, I'm putting up some charts that I've seen you share recently for manufacturing. We're seeing that the May ISM data is rolling over. If we look at the forward-looking data, it's doing the same. So, manufacturing is weakening. The housing market, you mentioned that mortgage rates have risen dramatically in a relatively short period of time. Roughly, they've doubled pretty much since last summer. Obviously, just mathematically, that's going to have to start bringing prices down, in addition to other factors that may be cooling the housing market off as well, at least in certain regions. Energy costs, just cost of living is persistently high for folks, and may in certain key areas even go up further. Who knows? But at least the pinch everyone is feeling, it doesn't look like it's going to go away anytime soon. And then if we look at households, even those that remain employed, we're seeing real wages continue to decrease month after month after month. I think we're something like 13 months straight of decreasing real wages. And with all of the extraordinary stimulus that was pumped out there in 2020 and 2021, that is done. And we're basically seeing that, people are maintaining their current lifestyles, but they're doing so by putting it all in a credit card. So we're back to, record revolving credit balances and whatnot. So that seems to be, a pretty predictive indicator that household finances are getting, more and more precarious. So I just rattled off a whole bunch of these things that basically suggest, hey, we could be in a pretty painful sort of recessionary position, I don't know, at some point in the next 6 months to 2 years or whatever. How worried are you about this, about America entering, a tougher time?
I think there's a significant probability of having a recession. And one thing to keep in mind is that recessions are measured in real terms. And so, for example, if inflation's 8% and nominal growth is 5%, that's a recession, right? So you're basically negative real growth for a prolonged period of time. And so we already saw negative.
And I'm sorry to interrupt, but we also have negative nominal GDP growth in Q1 and Q2 TBD, but the numbers coming down if you look at the GDP now numbers from the Atlanta Fed. So we could be in a position not too long from now where we're having back-to-back nominal negative growth periods.
Well, Atlanta Fed is real indicators, so they're looking at the real GDP.
I'm sorry, you're right. It is a real GDP number.
Yeah, but basically the hurdle rate is super high when inflation's high. And so that's kind of the challenge you run into. Basically, it ends up looking like an emerging market recession where, GDP in local currency terms is still going up, and maybe stock prices and even housing prices in local currency terms are still going up. Like if you look at Turkish equities or Turkish real estate prices in lira terms, they're going up. But in dollar terms, they're of course struggling. And so I think that, in a more mild sense, that's the kind of the environment we're in now, where real growth is struggling. Could be negative, could be very low positive. If we end up having a negative real GDP print this quarter, then we're arguably already in a mild recession at this point. But it's hard to say if that's going to happen. It kind of comes down to how accurate you believe the ones compiling the data are, right? Because these are inherently hard to measure. But I think that it's clear we're in a slowdown in real terms. And depending on some variables, like what happens with energy pricing, what happens with policymaker decisions, I think that easily could morph into a recession over time. I think that's a significant risk going forward, especially when you look at it as we do in real terms.
I don't see a lot of fear in the average consumer's eyes about recession right now. In fact, we still are sort of seeing the opposite with this great resignation, where people are still being very choosy about whether they want to go back to work or what type of job they want to take. My concern is that, I could make an argument that in a year's time, we're going to go from a jobs glut to a jobs drought. And all of a sudden, people are it's going to be the great unretirement movement, right? People are going to be begging for their old jobs back. Those jobs might not even exist if the companies have laid off. So I guess my question is how for people that are entertaining the idea of a recession could arrive, from your just best guess, is it going to be a light one and don't worry too much about it, or is it one that people actually should be taking precautionary action now for? I mean, could it be relatively prolonged? Could it be relatively deep?
I think people should take it seriously. I think that, these things are crystal balls, right? We're trying to predict this, severity of a recession. I think is inherently hard, and I'm not going to sit here in like an armchair and say, this is going to be the third worst recession in X number of years, and something that specific.
Yeah.
But basically,
Nobody knows.
we look at the combination of there's really not a lot of new energy capex coming online. And supply chains might be eventually improving somewhat as China opens, but I think the energy side is still problematic. And so we have real world constraints about abundance, basically our ability to have more goods and services cheaply. And then the other side of that, unemployment is one of the most lagging indicators. So all of the leading stuff happens first. We've already seen now nearly a year now of deceleration in terms of all those leading things. And we're just starting to see it show up in unemployment numbers, but from a very low base, right? So unemployment looks pretty good. And we're starting to see that slowly get a little worse, but from a pretty strong position. And so I think that as we look out, we'll see tighter financial conditions. Unprofitable companies will have trouble raising equity, right? So they're trouble growing and hiring more people. Very indebted companies will have trouble raising debt, and they might have to lay people off and slow down operations. And so I think that, and then that spirals when you start to get layoffs, you get weaker consumer demand, and then you get poor company performance that can result in more layoffs. And so I think that things that are discretionary in particular face squeezing here, right? So their costs are going up while consumer demand is also weakening. And so I think that can continue spiraling into a recession, and how deep or prolonged it gets then depends on what are policymakers doing, what is happening with geopolitics, right? Is there a
Mhm.
ceasefire, and maybe we're kind of getting some of the gum out of the system, or is that just getting worse? Right? There's all sorts of variables that are hard to predict 6 months, 12 months, 2 years in advance. And so that's why you can have a long-term outlook. Like I will say that I think inflation is going to be hot for the better part of this decade. That's a very long-term outlook. But that's still subject to kind of a quarter by quarter analysis of what's happening in rate of change terms, and kind of monitoring that thesis over time. And so it's not like saying, 2 years from now, this is the exact type of recession we're going to be in, or things like that.